Hello friends, welcome to Learn Easy. We will discuss margin ratios as profitability ratios in business. Two types of profitability ratios are there. First, margin ratios, and second, return ratios. Then we will discuss 7 types of margin ratios like gross profit margin ratio, EBIT margin ratio or operating profit margin ratio, EBITDA margin ratio, net profit margin ratio, cash flow margin ratio, operating expense margin ratio, and PAT margin ratio. One request, if you are new to my channel, please subscribe, share and press the notification bell. Profitability ratios help to determine and evaluate the company's ability to generate the income against the expenses it incurs. These are used for analyzing the company's performance. Profitability ratios over time demonstrates to examine whether a company's financial performance is improving or declining. Investors can use these ratios to determine whether or not a company be good for investment. There are several major types of profitability ratios that focus on different aspects of earning performance. Now, let us see the types of profitability ratios. Types of profitability ratios are: first, margin ratios, which are profitability versus sales. Second, return ratios, which are profitability versus capital base. We will discuss margin ratios here. Margin ratios represent the company's ability to convert sales into profit at various degrees of measurement. Margin ratios are: first, gross profit margin ratio; second, EBIT margin ratio or operating profit margin ratio; third, EBITDA margin ratio; fourth, net profit margin ratio; fifth, cash flow margin ratio; sixth, operating expense margin ratio; and seventh, PAT margin ratio. Now, gross profit margin ratio. The gross profit is calculated by deducting all the direct expenses, that is, cost of goods sold, from the sales revenue. The cost of goods sold primarily includes raw materials and the labor expenses incurred for production. The gross profit margin ratio is calculated by dividing the gross profit by the sales revenue. So, gross profit margin ratio is equal to revenue minus cost of goods sold divided by total revenue. A high gross profit margin ratio reflects a higher efficiency of core operations. A high gross profit margin ratio indicates that the company can cover operating expenses, fixed costs, dividends and depreciation, and also provides net earnings to the business. On the other hand, a low profit margin ratio indicates a high cost of goods sold. This may occur due to unfavorable purchasing policies, low selling prices, low sales, intense market competition, or ineffective sales promotions policies. Second, EBIT margin ratio or operating profit margin ratio. EBIT margin is a company's profitability from core operations by comparing earnings before interest and taxes, EBIT, to total revenue. EBIT is also called operating margin. EBIT margin ratio is calculated by dividing EBIT by total revenue. So, EBIT margin ratio or operating profit margin ratio is equal to EBIT divided by total revenue. A higher operating margin ratio signals better expense control and operating leverage. If operating margin ratio or EBIT margin ratio decline, it suggests challenges in managing operating expenses. Third, EBITDA Margin Ratio. EBITDA stands for earning before interest, taxes, depreciation and amortization. It represents the profitability of a company before taking into account non-operating items like interest and taxes, as well as non-cash items like depreciation and amortization. So, EBITDA Margin Ratio is equal to EBITDA divided by total revenue. Higher EBITDA Margin Ratio indicates better expense control, operating leverage and cash generation ability, where declining EBITDA margin indicate problems in managing costs or weaker cash flows. One request, if you are new to my channel, please subscribe, share and press the notification bell. Fourth, net profit margin ratio. Net profit margin indicates the percentage of revenues that translates into bottom line net income after all expenses are considered. It provides the final picture of how profitable a company is after all expenses, including interest and taxes, have been taken into account. So, net profit margin ratio is equal to net income divided by net revenue. A higher net profit margin ratio indicates greater efficiency in generating after-tax earnings for growing revenue, whereas declining net profit margin ratio indicates problems in controlling expenses or weaker profit growth overall. Fifth, cash flow margin ratio. Cash flow margin expresses the relationship between cash flows from operating activities and sales generated by the business. It measures the ability of the company to convert sales into cash. Cash flow margin ratio is equal to cash flow from operating activities divided by net revenue. A higher cash flow margin ratio means greater cash generation ability as revenue grows, whereas declining cash flow margin ratio indicates weaker cash conversion and potential issues with working capital or expenses. Sixth, operating expense margin ratio. Operating expense margin ratio compares total operating expenses to net revenue to quantify the cost efficiency of business operations. It measures what parts of revenue is consumed by operating costs. Operating expense margin ratio is calculated by dividing total operating expenses by net revenue. So, operating expense margin ratio is equal to total operating expenses divided by net revenue. A higher operating expense margin indicates challenges in managing costs or bloated operations, whereas a lower operating expense margin ratio means greater efficiency in leveraging revenue growth versus expense growth. Seventh, PAT margin ratio. PAT margin measures profit after tax, PAT, as a percentage of total revenue. It shows the after-tax profit per rupee of sales realized by a company after all operating and non-operating expenses. PAT margin ratio is calculated by dividing PAT by net revenue. So, PAT margin ratio is equal to profit after tax, PAT, divided by net revenue. A higher PAT margin ratio indicates greater profitability and tax efficiency, whereas a declining PAT margin ratio indicates challenges with cost control or weaker after-tax profit growth. PAT margin ratio analyzes true bottom line profitability after income taxes are paid. Let us conclude here. Margin ratio analysis gives an idea to stakeholders with the financial insights necessary to evaluate strength, weakness and drivers of profitability. Examining a company's profitability through margin ratios provides an invaluable perspective on operational efficiency. That's all. Thank you for watching the video.